I don't know about you, but they didn't teach me this in college. I didn't learn about the bank, why the bank statement has a debit and credit to cash that is the reverse of what you have on your books as a business. Hey guys, welcome back to another episode with the Financial Controller. Thank you so much for tuning in and watching another episode where I talk about the lessons that I learned throughout my accounting career over the last 16 years or so. And this is a new setup, so let me know what you think in the comment section. This is a brand new microphone. I have a green screen behind me, which is crazy. You're probably seeing some kind of fancy background right now, but there's just a green screen right behind me here. So anyway, in today's video, I want to talk about three things that confuse me. First one is retained earnings. So I'm going to talk about why I got confused early on in my career by the expression retained earning. What are we retaining exactly? Do we have to keep this money? Can the business spend it and still call retained earnings? This kind of thing. The second one is going to be debits and credits on the bank statement. Debits and credits in the bank statements are almost the opposite of the debits and credits of the cash that you record on the books. So that confused the hell out of me going into accounting early on. And then lastly is unqualified opinion. So a lot of you know that I started out working at PricewaterhouseCoopers. So I started out in audit. And the clean audit opinion is called unqualified opinion. And that confused me as well because unqualified has a negative connotation in real life. When you say, this person is unqualified to work here or there, that means he doesn't have the qualification, or someone is unqualified or unfit to be a father, right? And maybe some kind of custody battle. So that has a negative meaning as well. But in audit, unqualified opinion is good. So let's talk about these things coming right up. All right, so first up, let's talk about retained earnings and why that's been a confusing expression or term to me going into accounting. So probably go back in time about 17 or 18 years when I was doing accounting in college, studying accounting, probably not accounting 101, but maybe accounting 102, when we began to talk about the balance sheet and the accounts on the balance sheet. So when we got to retained earnings, the reason why I got confused by it is because the way my brain works in understanding expressions in accounting is following the meaning of the words. So when you say income, my brain is wired to understand money coming in. When you say expenditure, it just means cash going out. When you say long-term or short-term assets, right? Your brain naturally, this is how my brain works, and I suspect most people's brain work the same way. You naturally follow the meaning of the word. And when I heard retained earnings, the first thing that comes to mind is retention, is when you retain something. So the way that I thought of it is that this is the money that you accumulate or the profits you accumulate in the company, which is true. It is the accumulation of profits in the company. But retention to me meant that you have to sit on it. You have to keep it. So the retained and retained earnings is what got me confused into the meaning of the expression. While you don't have to retain it, you don't have to sit on it. You can spend it as a business into running the operations, to expanding, buying assets, all that stuff. You don't have to retain it per se, right? So then what is the definition of retained earnings? Retained earnings is the accumulations of net profit in the business. So imagine if you're running a lemonade stand, right? An easy example of a business. Every year you make a net profit. Then that net profit is added up each year and accumulates on the balance sheet as retained earnings. And how does that work in the real world? Let's take a look into how companies or corporations record retained earnings. All right, so in the real world and outside of accounting textbooks, the way that retained earnings is booked is automatic via the accounting software. So if you're using QuickBooks or NetSuite or Sage Intacct, the accounting software will close out the revenues and expenses to retained earnings automatically. So the way that works is that in the background of the software, it's looking at your business operations as revenues and expenses, right? These are the two main things, revenues and expenses. And it's booking those or closing those accounts, revenues and expenses, to an account called income summary, right? Income summary is a temporary account that you don't see on any of the statements, right? It's called income summary. It's a temporary holding account that the system will close out revenues and expenses to at the end of the period, right? And then what the system does is it looks at the net. If there is a net credit, which is more revenue than expenses, right? It will take that and close it out to retained earnings. And that's why it's a temporary account, because things go in it and then come out of it. And then the net is that income summary is a wash at the end. You close it out to retained earnings. So first, the system will close out revenues and expenses, net them out, get the net amount into income summary, and then book that into retained earnings. And that's how retained earnings make its way into the books. Well, then you might come along and ask me, what if the business is making a net loss, not a net income, right? Well, then there are really two scenarios. If the business historically has been making money and creating retained earnings over the years, and then suddenly, for whatever reason, an economic downturn, they have a net loss, then that reduces the retained earnings, right? However, if you're talking about a startup company and from the get-go they're losing money, that's mostly the case, right? You lose money for a number of years and then you start making money in the future. Then what you have is something called accumulated deficit instead of a retained earnings, right? That's the opposite, or the flip side of retained earnings is accumulated deficit. All right, let's move on to the second thing that confused me early on in my accounting career, which is looking at bank statements. So I'm going to put up here a page of a bank statement. And I remember when I started an audit, my first client, I looked at the bank statement. I was doing some review of their cash, and I looked at their bank statement, and it has debit and credit. Debit was when the money was going out of the bank. Credit is when the money was coming in as a deposit in the bank. And then I compared that to their books. And I realized that the client is doing the opposite of what the bank is doing. So the bank is doing a debit to cash, money going out. The client is doing a credit. And the other way as well. So when the bank is doing a credit, the client is doing a debit. So then I'm like, I thought it was an error. I was confused. I went back to my senior and I showed them, because I don't know about you, but they didn't teach me this in college. I didn't learn about the bank, why the bank statement has a debit and credit to cash that is the reverse of what you have on your books as a business, right? So the explanation that I got, and then I started to make sense as I went on in my career, is that when the bank says debit, that's cash going out. What the bank is talking about here as a debit is that they're reducing the liability to you, the depositor. So when you have a deposit with the bank as a depositor, the bank is recording a liability. Now, when they begin to spend that money, kind of giving you the benefit of that money back, right? That's them reducing that liability. That's why they do a debit. That's why it's called debit, right? But what you do with that as a business is you have to record a credit on your books, right? And the easiest way to remember this is looking at the acronym dealer, right? So I have this PDF. Maybe I'll put a PDF link in the description below showing the acronym dealer. So this is a good cheat sheet to have where you can look at your, dealer, dividend, expenses, assets, liabilities, equity, revenue. On the debit side is dividend, expenses, and assets, and on the credit side is liabilities, equities, and revenues. So there's a good cheat sheet to have to remember when to debit and credit your cash when it comes in or goes out the door. Obviously, with cash, you want to increase cash. It's an asset. It's a debit. You want to reduce it. It's a credit. So I'll leave a link down below to this. But this is the second thing that confused me early on in my accounting career. The bank has a reverse debits and credit to what's in the books. All right, moving on to the third and final thing that confused me early on in my career as an accountant. And as I said before, I started out in audit with PwC. And when you look at the types of audit opinions, when you finish the audit engagement and you're ready to give an opinion on whether the financial statements fairly represent the financial position of the company, the clean audit opinion is called unqualified audit opinion. And the reason that's confusing, again, with the same theme we said before, is that my mind tend to follow the meanings of the words. When you say unqualified, that has a negative meaning in my head that something doesn't qualify. You're not qualified for the job. You're not qualified to be a parent. You're not qualified. It's negative, right? But in this context here for the audit report, unqualified means a clean audit opinion, and it's given when the auditor thinks that the company's financial statements fairly represent its position, and also the company follows the guidelines, whatever it is, US GAAP or IFRS or whatever the case is, right? So unqualified audit opinion is a clean opinion. So then you might come along and ask me, why is it then called unqualified audit opinion? Well, the answer lies in another type of audit opinion that exists, which is qualified audit opinion. And the reason why it's called qualified audit opinion is because it has a qualifying statement where the auditor says, except for X, Y, or Z, we agree with the financial statements, that the financial statements represent fairly the financial position of the company. But they have a qualifying statement that says, with the exception of this set of revenue transactions that we disagree with management. So often it is issued when there is a disagreement on one type of transaction or a subset of transactions where the auditor disagrees with management, right? So this is they give a qualifying statement, and that's why it's called a qualified report, even though that sounds better, right? But it's not. It has a qualifying statement, whereas the clean audit opinion is called unqualified, meaning I don't have to qualify with any kind of statement. This audit report or this audit opinion is clean. The company's financials fairly and squarely represent the financial position of the company. Go ahead and tell me something that is confusing to you in accounting in the comment section below. I'll try my best to get to it. And if you haven't already, go ahead and give this video a thumbs up so it reaches as many people as possible. Subscribe to the channel if you haven't already, and check out my website for best-selling online courses on accounting, interviewing, financial analysis, and a few other things. But until then, I'll see you in the next video.